Chapter 2, Assets and Liabilities. If you run a business or you are learning all you can about business, you would understand that your balance sheet is important. With the help of your balance sheet, you can identify and distinguish how much you have as a business, how much you owe, as well as the investments you have. If you still wonder what asset, liabilities, and equity means, I just explained it in the previous paragraph. Assets. This is what you own as a business, not as an individual. Your assets may be investments. It can be money, which could be cash or money saved up in the bank, or money your clients owe you. It could be property, which covers building or other fixed assets such as furniture or machinery. It can be other intangible assets such as trademarks, patents, and non-complete covenants. For accounts classified under assets, it could be classified as long-term or short-term. The short-term assets are those that are liquidated in order to settle liabilities within a year. Short-term assets can only be sold or used. Long-term asset differs from short-term assets because they aren't used or sold in a year. Liability. This is what you owe your credit facilitators or lenders. Liabilities can also be owed to individuals, which can be used since you and your business are separate entities. Other businesses, the IRS or other financial facilitators. Liabilities are also monies owed to vendors or people who render services for you. They are business loans, prepaid services, and money that you owe your clients. Liability accounts can also be short-term and long-term accounts. Equity. What you have as your investment is your equity. Equity can also be described as the total net worth of your business. I describe equity in a simple way, which is your assets void of your liability. Just like asset and liability, you can also have equity accounts. This can be relative earnings, which is a sum of your total profit and loss realized in the business since its inception. It can be distributions, which is money taken out of the company by the shareholders, partners, and owners, and it can be contributions of money invested in the company. At the end of your financial year, the net profit or loss of the business, which is generated from the profit and loss, is deducted or added to all the earnings retained, while the total amount of money in accounts dedicated to income and expenditure set back to zero. Unlike assets and liability, equity account can be described in different names. If you are a sole proprietor, your equity account will be referred to as owner's equity for the money put into the business. When the money is given back to the owner, it is referred to as owner's draw. For corporations, they have additional contributions invested by the shareholders, which is also known as APIC, additional paid in capital. There is a common stock account, which is the initial investment poured into the company. There's also money paid back to the shareholders, which can either be their earned share of the company's profit or a return of their investment made to the company, which is known as shareholders' dividends or distributions. The corporation can also have a common stock account or the initial amount invested in the company. Build your own infrastructure. What many business owners fail to realize is that the more liabilities you acquire, the more you get roped into more liabilities. Don't make it about credit cards, facilities, mortgages, overdrafts, borrowing money for cars, property. If you need to acquire more items, buy it for cash. You need to be able to build your own infrastructure. This means your business must have its own asset base. You must be able to move from debt to zero and from zero to having a strong asset base. You can start small. There is no need to impress anyone. If you try to start big, you may eventually run into debt and take on more liabilities than you need. This way, you grow from scratch with no liabilities in between. This is the best way to build your own business and infrastructure. The best way to go about this is to build yourself up from the scratch. Begin your own business and live within your business with no liability and avoid taking loans. This is because taking loans will also involve taking more loans. Credit facilities only give out loans based on the amount of money you intend to borrow, as well as your compliance to their rules. For you to be compliant, you have to be able to take on more liabilities. If you decide to take a job in order to get a salary, So you can save up, then try to avoid taking loans and liabilities. It will be difficult, but it is attainable. You don't have to depend on any paying out schemes. If it comes, you're good, but live your life like you aren't expecting any payment scheme, whether pension or insurance. This is because pension and insurance systems have failed for the people. For insurance, they don't pay out and they create their own system to ensure that you never cash out. Less than half of the people who register for insurance don't get to receive the money again.